works for almost everybody. Thank you so much for coming to our Citizens Financial and the Hinton Group webinar regarding the amazing 321 Buydown program. The 321 Buydown program is amazing. First, let's get the whole scope. This program has really been an invention of a way for kind of the housing finance market, like capitalism, to find a way to thrive and survive during kind of the downturn. The Federal Reserve has raised the federal funds rate at an insanely high ramp rate. So therefore, we've seen rates really jar and adjust upwards. Mortgage rates have never risen as fast in the last 20 plus years. So we're seeing a little bit of a jarring effect. Year over year, we were looking at rates 2.75, now we're in the sixes. So we're seeing a way for our clients have to adjust. When it comes to affordability and the housing index and kind of cost of living, wages have not increased at the same speed that rates have. So therefore, affordability has been directly affected. I know we're all kind of seeing the headlines of possibly another leg dropping the market, the housing market. It's going to crash like it did 10 years ago. We're not seeing that. You're seeing month over month, year over year, certain counties, 3% drop, 4% drop, 5% drop. Yes, there is the outliers across the nation, but in our microclimates of Northern California and Southern California overall, excluding some very extreme outlier markets like in San Francisco or in the peninsula, where the values were horrendously high and you're seeing dramatic reductions because just the outliers effect. In the traditional median house market, you're seeing about 3 to 5% max year-over-year reduction. That's based on essentially rates have gone up. So therefore, the buying power has been not dramatically reduced to a rate where you can see 50% reduction in the house value. But we are seeing the rise in rates is capping affordability. So therefore, people can't attain that price. They're not able to pay for that house when the cost of owning has doubled or gone up 33% in the last year. So we are seeing the highs go down to try to find that equilibrium point where clients are able to pay that cost for the subject asking price of the house. One of the biggest determining factors is affordability with the rate. Okay, I love the house, but I can't see myself paying XYZ to live there. The 321 solves and resolves a lot of this. We are having a great success providing this product. An example, we can go circle the slides, give you kind of a rundown how it works. First slide. All right, temporary buy down. This gives your client extra flexibility with lower monthly payments by offering a temporary rate buy down to lower the interest rates at the start of the loan. So it's that simple. We'll go through the slides to explain how it works. A client will come to you or come to us. We'll pre-approve the client based on affordability. The buyer decides they want a lower interest rate for the first 3 years. The 321 buy down, for example, year one, the rate's 3% lower. Year two is 2% lower. Year three, it's 1% lower in the third year. So it's absolutely amazing. They can qualify the fully indexed rate. What fully indexed rate means is the rate in which the client was qualified. So say we qualify the client to be able to afford a house at $500,000 purchase price, so 10% down with a rate of 6.125. Regardless if that's not the first year's payment, we know they can afford to make the house and stay in that home at a 30-year fixed for 30 years, amortization at 6.125. The amazing part is at year one, the rate is 3.125. The next slide, I think, will show an example of that. Well, maybe the next slide. This just shows you the temporary buy down availability. The conventional second home purchases, VA and primary. So VA, as you know, VA is for your primary residence only. Conventional and FHA will work. Conventional does your second homes, FHA is for primary residence only, okay? So VA and FHA, look for that for your primary residence. Conventional can be for your second home and for your primary home, okay? Next. So the real benefit here, help borrowers lower interest rates by 3% at the start of the loan. The buy down is really is really important. It has the ability to, the value here, oh, sorry, wrong way. Have access to seller concession and apply it towards the buy down advantage of a lower rate. That's really the basics of it. If you are making that payment yourself, it's really expensive, guys. An example, you might spend $20,000 to $35,000 to buy the rate down on a house on the purchase price, maybe $600,000 to $700,000. If you're buying a new home development, the new home builder will be giving you a closing cost credit. Apply that to the buy down to make the house extremely affordable. In the existing home market, sellers are now providing a closing cost credit to pay for closing costs. If they give you that, you can apply that towards a buy down fee. This is an exceptional loan if you are not the one paying that buy down, because it is expensive. You will already be straddled with 10% down plus closing costs and the buy down fee. Okay, those are all three mutually exclusive fees. If you're getting assistance from the sellers, absolutely utilize this program. Even if you're not, still take advantage of it if it helps you get in the home, with the whole goal that in the future, we will see the market go down, rates will come back down. We're kind of fighting the recession and with inflation. Jerome Powell, the head of the Federal Reserve, has stated that we will start to see kind of tapering back of the federal funds rate increase probably 2023 and midway through. So we're going to see some reprieve in the rates probably by another 6 months to 9 months. But the next bullet point, you can utilize your money towards renovations. If you're not buying a new home, you might want to take the money to make that home your home, make it special. So therefore, if they're giving sellers concession, please use their money for the buy down, not yours. $20,000, $30,000 from their account. They use the money that you have for your family to help fix the house up when you have it there. Okay. The buy down enables you to go from renting to buying with less of a payment shock. So that's the main thing. You might have been paying $2,000 a month paying rent, but your lender tells you you're pre-approved to afford a house with a maximum payment of $39.50. Just because you can pay $39.50 doesn't mean it's not going to make you almost pass out. That's the biggest thing about payment shock. Realizing, oh my gosh, this is how much of my monthly income I'll have to utilize to become a homeowner. Even though you're qualified and on paper you can afford a $39.50 mortgage payment, in your mind, you're like, that's a lot. Doing the buy down will help relieve that stress, because year one, your payment will be 3% lower. That would align your first year's mortgage payment with your rent base you're paying now, to have less of that kind of the shock. Plus you ease into home ownership in the next 3 years. With the goal, probably about 9 to 12 months, you should be contacting your lender, like myself or anyone at the team or the Hinton Group, to want to refinance. Watch the market. When you see the current 30-year fixed market start to get par and parallel with your year one rate or your year two rate, that is the optimal moment when you want to take that mortgage and freeze it. Let's say the current market in 11 months is giving a 30-year fix at 4.375. And on year two, you're at 4.125. That marginal difference is insignificant. You want to close the gap, lock that mortgage in for 30-year fix, and have something that's secure. Okay, that's really the goal. It enables you to kind of flow from renting to buying with less of that shock. Next slide. Okay, here's an example. I jumped the gun. Very simple. 30-year fixed conventional home, 3-2-1 temporary buy down, 350 loan amount, 700 FICO, 10% down, 9% LTV. You can kind of see how it works. We are estimating a rate 6.75. Now that's high. As of today, we're seeing about 6.125 is our 30-year fix based on 3-2-1 buy down. So at a rate of 6.125, you would have a 3.125 year one payment. But for the sake of this, we always want to overstate stuff. 6.75. You're going to see how year one, you're going to save $640 a month. That's huge. Year two, you're at 444. Year three, you're at 227. There's the benefit. That's how much you're saving based upon the rate on year 4 to year 30 that you know you can pay. That 6.75 is a monthly payment that you verified, validated at the close of your escrow, when you got handed the keys, you were able to make that payment of $2,270. Able and wanting are two different things. That's why this program is so amazing. Next slide. Okay, so what happens if I sell my property or refinance? This is the main question out there, all over the internet, all over YouTube and all the channels. How does this thing work? Where's the money go? It's pretty simple. Any remaining balance of the buydown will go towards the principal balance. The borrowers do not lose their money. You do need at least 10% down for a conventional loan to get the maximum sales concession. So yes, you could do 3.5% FHA. Yes, you could do the first home buyer program with conventional at 3% down. But they will cap you on the total amount of money that would be allowable to be utilized towards your buy down. Fannie Mae, Freddie Mac has certain rules, so therefore you're capped. So you would have to contribute some money toward the buy down plus your down payment. So to maximize 100% of the buy down feature, this product is best with the 10% down Fannie Mae loan. If you need to utilize FHA, or if you're a veteran. Now, a lot of people say, why would a veteran want to utilize this? The 100% financing the rates are the best. That is true. Some veterans still need to utilize other programs with loss of entitlement or other issues, or to make them more affordable. If you're a veteran, 100% financing, you find a house that, you know what, 100% financing, no mortgage insurance, and doing a 3-to-1 buy down is absolutely amazing, because the sellers are paid for it. You have 100% financing with a rate that's fantastic in the threes. And then they can in 12 months, 6 months, 9 months, you do what's called an IRRL, interest rate refinance reduction loan through the VA. They love their acronyms. It is a rate term refinance, no appraisal, no pest, easy. So there's a lot of awesome things you can do to get into this program to help utilize the lower payments the first few years. And when you refinance, that money that's held like it's like a sub escrow account, you're essentially paying your interest in advance on year 1, year 2, and year 3. That money, when you go to get a payoff on your payoff for your mortgage, that money gets credited towards the principal reduction. So you don't lose the money. It's very important. A lot of us have worried, oh my gosh, if I put some money in this account, do I lose if I refinance early or sell? No, it just gets paid off towards your down payment or your payoff demand. Pretty simple. Next slide.